everybody. Welcome to today's fundamentals. Hello, Pedro.
Hello.
What's up in the FX market?
Well, the euro, the British pound, and the Aussie have all been moving in an upwards fashion. Now, one could attribute the euro's ascent, as we said yesterday, to a strengthening of the euro, considering that the ECB is anticipated to hike their interest rates by 25 basis points in the ECB's meeting tomorrow. Hence, given the dollar weakness, one may anticipate that the euro will continue in its upward trajectory. Now, the pound has been going up since yesterday's employment data. The employment data tended to show a strong, resilient labor market within the UK. However, following today's GDP rates, it appears that the pound may be losing some steam. Why? Well, it came in lower than expected, indicating despite expanding, albeit it's doing it at a slower pace. Hence, a slowdown in the UK economy may diminish, well, or at least in part, lower the pressure for the Bank of England to continue on its aggressive rate hiking policy. Well, whereas the Aussie is moving on the up, perhaps capitalizing on a weaker greenback. However, we note that the financial releases which are due tomorrow may impact the Aussie. The dollar against the Japanese yen is moving in a sideways fashion. Now, we anticipate the dollar against the yen to move in a sideways fashion until the interest rate decision today. So we may see the yen gaining some ground against the dollar should the forward guidance presented by the Fed not be as hawkish as is currently predicted by the markets, with the Fed's funds future rate anticipating, and if I'm not mistaken, a 97% probability for, 91% probability for the Fed to remain on hold. Yet many analysts are expecting that it will be a hawkish pause in which the forward guidance indicates future rate hikes. So should that not be the case in terms of future rate hikes being more aggressive, we may see the yen gaining on the dollar. And the dollar against the Turkish lira appears to have halted at the $23.65 mark, perhaps a sign of dollar weakness rather than the Turkish lira gaining, because as we said, the Central Bank of Turkey has shown no indication currently of them willing to switch from their unorthodox economic policy. And then the dollar against the loonie. The loonie has been gaining against the dollar. Once again, the greenback is weakening, which has allowed the loonie to capitalize on the weakening dollar.
And how has gold's price been reacting?
Gold's price moved slightly downwards yesterday, but as of today's early morning session is moving slightly upwards. Now, the downwards movement may be sort of surprising considering that the dollar has been weakening, which one may have anticipated that would have allowed gold to capitalize on a weaker dollar and move higher. Yet it appears that fears of a recession may be waning, or perhaps global economic downturn may be reduced, hence reducing the need for gold. However, we do note that the Chinese central bank has been stacking up on gold as with many other central banks, hence a slight surprise of gold's price moving downwards.
And how about US stock markets?
Well, the US stock markets have been all moving up with the S&P 500, the Nasdaq 100, and the Dow Jones 30. However, it appears that the upwards momentum may be waning, which may be in part that the AI-induced hype, which one could also say is some form of a bubble, may be slowing down. So we're seeing that this rapid rise may be coming to a halt despite anticipations of a pause by the Fed. We may see the US stock markets move in an upwards fashion, but at a slower pace.
And how about oil prices?
Well, oil prices have been up. Following a Reuters report earlier this morning that Iraq's oil production has been underperforming its anticipated releases set by OPEC, it appears that the reduced supply in the oil market has facilitated oil's rise upwards. In addition to America announcing that they would be buying approximately 13 million oil barrels to fill up their strategic petroleum reserve, may have provided some support, as it appears that the US may be trying to mend relationships with Saudi Arabia by buying oil, hence bringing oil's price in an upwards fashion. Hence, we may see oil moving slightly higher.
And what's in today's calendar?
Well, in today's calendar, we note the Eurozone's industrial production on a month-on-month basis, the U.S. interest rate decision, which is due to be the highlight of the day, including Fed Chair Powell's speech following that release. Now, it may be interesting to see what the Fed Chair says following the interest rate decision, where should he aggressively hint at more rate hikes in the future, we may see the dollar gaining if it is substantial enough. Whereas personally, I expect that the Fed chair may remain with a hawkish pause in terms of saying perhaps we're remaining on pause now, yet we may hike a few more times in the future, yet not too aggressively. And during tomorrow's Asian session, we note a very busy Asian session. New Zealand's GDP, Japan's machinery orders, Australia's employment data, which is expected to impact the Aussie as well. In addition, China's industrial output, which is anticipated to perhaps influence the Aussie in terms of trade. So if China's industrial output is greater than expected on a year-on-year basis, it may provide some support for the Australian dollar, as China is the main importer of Australian goods, hence providing some support for the Aussie. Yet, the urban investment and the retail sales may affect the Chinese yuan.
Great. Thank you, Fedor, for your time. And everyone for watching. Join us after a short break for technical analysis.
Hello, everybody, and welcome to today's technical analysis. So, we're going to be starting off where we left off yesterday, looking at Intel. So, we're currently on the 4-hour chart, and yesterday we noted resistance at $33.05. As you can see, it touched beautifully on resistance at hour 1 and then moved higher. It continues validating our upwards moving trend line. Now, this trend line has been incepted on the 25th of May and is moving in an upwards trajectory. So we're maintaining a bullish outlook. Yet the reason why we're maintaining this bullish outlook is, firstly, it's above the RSI figure of 50. It's nearing 70, which implies a strong bullish sentiment within the market. And as you can see, it touched R1 and is moving higher. So validating our resistance placed yesterday at R1. So the next potential target for the bulls, in my opinion, would be the resistance at level 2 at 34.60 US dollars. So this would be the next target for the bull should the bullish momentum continue. However, we note that the Bollinger Bands have widened, implying high market volatility. So what this means this is at the upper end of the Bollinger Bands, hence a market correction lower to the mid-range, which currently coincides with our upwards moving trend line, may be due before moving higher. So even if it does break below R1, I would not necessarily switch to a bearish outlook. For that to happen, it would need to break below S1 at 31.35 and then a move towards S2 at 29.80. So we maintain a bullish outlook for Intel, given that it broke above resistance at 33.05. And if we look at the daily, the wick hits exactly on resistance at R1, validating our resistance level. So having broken above, this would become S1. Yet the Nasdaq, as we said in the fundamentals, appears to be losing some momentum. We'll look at the Nasdaq 100 index in a few minutes. For now, we're going to be staying with Intel, and I'll explain why. So this waning of momentum, I would say, may be indicative of the AI hype that's been driving the Nasdaq up, may be coming to an end. Yet we're still seeing a lot of speculators and supporters of the AI industry, fueling stock prices to higher levels. So it may be a temporary halt, before moving higher. So R3 now becomes R2, and we're going to be looking for our new R3 level. So once again, personally, I like having some substance to the bodies of the candles. As you can see, it's touched beautifully on RR1. So my new R3 would be, excuse me, would be perhaps at the 37.61 level. That might be a bit too close for comfort. So the next level for me would be around the $38.19 mark. However, before I validate this as R3, I'd like to see an equidistant between R2 and R3. So we need to go back and just make sure that this is actually, we can't go that far back. So based on the data that we have, this would be my R3. This could also be a resistance R3. This has more substance and is more in line with my own analysis. So this would be R3. I'm going to be moving it slightly lower. And why is that? Because at this level here, had I placed R3, you can see there's not a lot of bodies providing some substance to R3 as a level. Despite having a touch here and one here, it perhaps is not enough. Whereas multiple touches along R3 at 37.62, perhaps we could even put at 37.60. So this for me would be the new R3. So we've got R1 at 34.60, R2 at 36.15, and we're going to be putting R3 at 37.60. So Intel has been on the up and up since yesterday. As we mentioned, that they may be looking to become an anchor investor in British chip designer ARM, which would allow them to gain a majority, well, not a majority, excuse me, a large amount of shares pre-IPO, hence potentially benefiting from ARM's IPO. So this is our chart for Intel. Moving higher, having broken above resistance, now turned support at 33.05. Maintain a bullish outlook for Intel as the RSI figure is at the reading of 70. So strong bullish sentiment, upwards moving trend line, and breaking above resistance, now turned support, validate our hypothesis. Now, what is interesting as well is the dollar against the Turkish lira. So if you give me just a moment, we're going to be opening that chart in just a minute. So as you can see, the 2370 level, perhaps we could have even placed the 2350 level, has been acting as a barrier to stop the ascent of the dollar against the Turkish lira. Now, as we said in the fundamentals, the lack of news surrounding the Turkish central bank of perhaps switching from their unorthodox economic policy may be the reason as to why the Turkish lira has failed to gain against the dollar. So this would not be Turkish lira strength, this temporary lull or pause, but instead the dollar's weakness as the markets anticipate a hawkish pause by the Fed. So it's staying at the 2370 level currently on the 4-hour chart. On the daily, we're seeing it's failing to break above R1. So we're going to be keeping our support and resistance levels the same as of now. Now, it's still running along the figure of 70, implying a strong bullish sentiment remaining within the market. Yet it appears to have stalled up until the Fed's interest rate decision, which is due later on today. Now we're going to be moving on to oil. Now, oil is an interesting story. As you can see, nice gap here. Well, gap. Nice U figure breaking, failing to break above 50, then breaking above 50, implying a bullish market sentiment. Well, an emerging bullish market sentiment is broken above the mid range of the Bollinger Bands. Now, it corrected at the mid range and is moving higher. So I would not be surprised if it does break S2, well, which should be R1 now at 70.75. So personally, this might be the formation of an upward trend line, albeit it's very steep. So we're maintaining a bullish outlook for oil. Now, the reason why we're maintaining a bullish outlook is the US announced yesterday it was planning on buying about 13 million barrels of oil, potentially supporting and making amends with Saudi Arabia. So by buying more oil to refill their strategic petroleum reserves, the US is inadvertently bringing oil's price higher as there is a higher as there, excuse me as there is an increase in demand. So this would become R1 at 72.30. It's there's only $1 between R1 and R2. So for our bullish outlook to continue, excuse me, there's a mistake. This should be R2. R1 is at the 70.75 level. So let's just remove these. We're going to be removing S3, R3, excuse me. So oil has been moving in an upwards trajectory. As we said, the announcement to purchase 13 million oil barrels appears to be supporting crude. So 75.66 will be R3. And let's look. It failed to break above. There was a wick, yes, but the bodies remained slightly near R2, then moved lower, broke below support trend resistance, fluctuated between R1 and R2, and then moved lower, breaking below R1 at 70.75, which was support now turned resistance. So it wasn't a we did hold a bearish outlook for oil, yet now we're switching, we're holding a bullish outlook, and S3 actually could become S1. Yet I'm seeing support at a higher level at 69.40. This would be S1. It appears that the fears of a reduction in global demand have not materialized, which is potentially allowing oil to move higher. So this will become R1, S1, excuse me. So S1 at 69.40. And why are we placing RS1 at 69.40? Well, as you can see, there's a few touches here, validated here. As you can see, it's swinging, well, fluctuating between our new S1 level, which appears to have validated once again here before moving higher. So it consolidated and then it moved higher. So that for me validates this as S1. So S2 at 68.50, we're keeping that S2 level. R2 at R2 could be placed at 72.30. And that would mean R2 now becomes R3 at 73.50. So this becomes R2 at 72.30. Now we're on the hunt for S3. So S3 for me would be placed around here. Now, why? Look at how the bearish candle closed. There is a slight wick upwards, yes, but look, nicely moved lower. Bullish candle, there was a wick, but the body hits S3. And then the second body of a bullish candle hits S3 and once again. The wicks for me don't matter that much. The bodies do. The open and close matter a bit more for me as they carry more volume in my own opinion. So this for me would be S3. This could also be S3, a slightly higher level here, which may be more in line with our current analysis, yet it does not invalidate that this might be S4. However, looking at this, perhaps it would be better to put S3 at 67.15, excuse me, as it would improve our consistency with approximately $1 in between our support and resistance lines. So R2 needs to be switched to 72.30. 72.30, 73.50, 70.75. And now our S3 at 67.15. So we're maintaining a bullish outlook for the price of oil for the reasons I mentioned before and in our fundamental. But just a small recap, it's moving above 50, so it implies that there is a bullish sentiment potentially emerging in the market. Recent reports that Iran's has been underperforming the oil production requirements has reduced supply in the market, hence reduction in supply makes crude more valuable as there is a decrease in supply and an increase in demand, pushing prices higher. In addition to the US stating that it would be buying oil barrels to refill its SPR, may be facilitating oil's price in an upwards fashion. Now, there is also a third alternative to this. Should the Fed remain on hold, it may ease pressures on the US economy. So, by easing pressures on the US economy by pausing interest rates, it may facilitate more spending in the economy, hence increasing demand for oil. Whereas, should interest rates increase, hence QT, that may reduce demand for oil in the long run as consumers would be willing to spend less. Hence, reduced economic activity, reduced demand for oil, lower prices. Whereas a pause provides the opposite picture, so moving higher. Note, small market correction, moving higher, validating the upwards moving trend line. Next target for the bulls, $70.75 figure, which, as I'm seeing as well now, it has broken above the 70 key psychological figure. Also, another statement that may support our case for a bullish outlook. Whereas for a bearish outlook, breaking below S1, with the next potential target being S2 at 68.50. And now we're going to be looking at the Nasdaq 100. It's broken above our sideways moving channel, validating R1, moving towards R2, and we could even place an upwards moving trend line as well. As a matter of fact, we could potentially see an upwards moving channel as well. So we have a lot of stuff going on in this chart. So let's break it down together. It's failed to break above S1. It's broken above resistance turn support once. It's validated, consolidated, moved higher. It's reached the upper bounds of the Bollinger Band, so perhaps a market correction due slightly lower may be expected. Yet there's an upwards moving trend line formed on the 8th of June, if I'm not mistaken, yes, and it's moving higher. Now we're also noticing the formation of an upwards moving channel, albeit it's a bit narrow. However, it seems to be validated by the upwards moving trend line, the RSI figure remaining above 70, implying a strong bullish sentiment within the market. However, on the daily, As you can see, it's moved higher, 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 yet it appears to be losing some steam yesterday, which goes to say perhaps the AI hype may be running its course or it may be consolidating before moving higher. As should the interest rate decision today by the Fed, which is the key issue for today, a hawkish pause may make stocks cheaper for overseas investors, and it's pushing the Nasdaq, the Dow Jones 30, and the S&P 500 in an upwards fashion. So S1 will now become S3. Why? It's broken above two resistance levels, now turn support. So we need to switch our outlook to support. Excuse me, we need to switch our resistance lines to support. So this would become S2 at 14,465. And as I've said before, the reasoning behind the support and resistance levels is due to the price action remaining between them, the bodies of the candles validating and moving higher, and R2 now becomes S1. So this will become S1. We could keep our prior support levels for future reference as we did yesterday, yet it appears there's no need for that today. It's just clogging up slightly the chart as we're moving higher. So we've got R1 at 15,165. So this for me would be the next target for the bulls. In order for my bullish outlook to continue, it would need to have to break above R1, with the next potential target being R2. Yet it would appear that R2 might be slightly higher. So we may try and find a midpoint between R1 and R3. Well, or perhaps bringing it lower. Once again, the bodies of the candles provide a greater value for me personally. So this would be R2 and R3. Perhaps could be at 15,754. This is a bit too close for comfort. Touching the wicks of the bodies, there's ample space between them. Yet, this may be more valid. Multiple touches, bodies of the candles. So this for me would be R3. 15,750. So this becomes R3. So for our bullish outlook to continue, breaking above R1 with the next potential target being R2. $15,750. And we're going to be placing S2 at 15,400 and 15,455. So this would become R2. So let's just fix our chart up a little bit more presentable. So we're maintaining a bullish outlook for the Nasdaq 100 as it's validating our upwards moving trend line and our upwards moving channel. It's also broken above two resistance levels, now turned support. And we're moving on to the S&P 500. Stemming from yesterday, it's validating our upwards moving trend line. It's aiming for R1 at 4,400. Hence, what we could bring up higher would be our S3 at 4,365. So we're maintaining a bullish outlook as well for the S&P 500, given that the RSI indicator is above 70, implying a bullish market sentiment. So we're going to be switching S3 to S1. At 4,365. This becomes S1. It was validated in the previous trading session. S1 becomes S2, and we're going to be keeping R1, R2, and R3 the same. Why? Because it's aiming for R1 currently. Hence, we maintain a bullish outlook should it break above R1. Whereas for a bearish outlook, breaking below S1, the upwards moving trend line, with the next potential target being S2. So we've got S1, S2, and S3. R1, R2, and R3. So it's currently probably going to go test resistance at 4,400. So should it break above R1, we maintain a bullish outlook with the next potential target being R2 at 4,465. Dow Jones 30, it failed to break above R1, as you can see, but is breaking below our upwards moving trend line. Yet the RSI indicator is still at the reading of 70, implying a bullish market sentiment. So I would not be surprised if it tests resistance at R1 once again. So should it fail to break above R1 for a second time, we may see the Dow Jones 30 moving lower towards S1. Yet I would maintain a bullish outlook for the Dow Jones 30 should it break above R1. I need a clear break above R1 for me to maintain a bullish outlook for the Dow Jones. Despite breaking below the upper trend line, that's all right for now. As you can see, it was at the top of the Bollinger Bands, maybe testing to the mid-range. So we're still maintaining a bullish outlook for the Dow Jones 30. And now gold. So as you can see, gold's price was moving in the sideways moving channel. It's breaking below, yet validating our upwards moving trend line despite a small correction lower. It bounced off, moving higher, going to test support now turned resistance at 1,955. This has been validated numerous times. So we've had this support level since the 19th of May. So it's been tested once, twice, thrice, about 15, about 10 to 15 times it's been tested and validated as a support level. Yet it's been broken below, so this becomes resistance. And as you can see, we've maintained our prior S3. So we've already got our S3 in place. So this becomes R1. R1 at 1,975 becomes R2. And 2002 becomes R3. So we're just switching around our resistance and support levels. These have been validated time and time again. So we could actually bring S2 slightly higher. S1 could be brought at 1,938. Why? Well, we're seeing that it's touched here twice, again and again. So despite it being potentially correct at S2 at 1,935, it does not mean that there's a new support level being brought up higher at the $1,938 mark. So we're keeping our prior R3 level as well, because should it break above R1, it becomes once again resistance turn support. So this becomes S3. At 1,885. S3 becomes S2 at 1,910. So S1, S2, S3, R1, R2, R3. Personally, it's broken below the RSI figure of 50, implying a potential shift from a neutral market sentiment towards a more bearish sentiment. Yet, if the Fed remains on pause and its forward guidance is less hawkish than is anticipated, so a slight mention of a potential rate hike in the future, and that is not a given, we may see gold capitalizing on a weaker dollar, once again highlighting their inverse relationship. Now, one might ask, this could also be a sideways moving channel between S1 and R2. Well, not R2, slightly lower. This could, in theory, yes, be a sideways moving channel. But personally, R1 has been validated so many times over nearly a month now that it provides more weight to me to maintain the current level and the sideways channel rather than forming a new one as of now. Yet, if it comes to this level once again at the $1,966 mark, then I would be bringing R2 lower and forming a sideways moving channel. But for now, it appears that this continues to be validated with R1. And by bringing R2 lower, it would be slightly narrow, too narrow for me to have a bullish or a bearish outlook, which is why we're maintaining our current levels as they are. We can see that the dollar overall has been weakening against its counterparts. If we move on to the daily, move lower once again, testing support at 103.05. Now, it's expected that the greenback would weaken, as by pausing interest rates, it would allow other currencies to gain on a weakening greenback, hence the dollar index moving lower. Now, the euro against the dollar is testing resistance once again at 1.0805. So let's just place this to highlight it. So R1 at 1.08050. Now we're maintaining a bullish outlook for the pair, so for the common currency. We noted this previously, failing to break below, moving higher. A bullish market sentiment, validating our upwards moving trend line once again. Hence, we maintain a bullish outlook if it makes a clear break above R1, which it appears to be trying currently. So, should it break above R1, the next potential target for the bulls may be the 1.0910 resistance level, with the next potential target for the bears being R3 at the 1.10 key psychological figure. RAS should break below the upwards moving trend line and break below S1 at 1.07350. We would switch to a bearish outlook for the pair. Now, this could happen today. The Fed hiking is not a given. It's what the markets are anticipating based on the financial releases. So, even if there's a 91% probability by the markets that the Fed will remain on pause, it does not mean it is a given. The Fed could still decide to hike interest rates. Why? Combating inflation, persisting inflationary pressures in the US economy. So it may be a surprise to the markets, and it is still a possibility. It is not a given, and it will be determined in today's interest rate decision meeting. So this becomes S3, and we would put S3 at the 1.05450 mark. Maintaining a bullish outlook for the pair, remaining near the figure of 70, validating our moving trend line and testing resistance at R1. So for our bullish outlook to continue, break above R1, next potential target being R2. And lastly, well, we could pick. We could either go for the yen, which appears to be breaking above R1. So perhaps a bullish sentiment, yet I personally think it will remain in a sideways moving fashion between the 140.18 mark and the $139 mark until the Fed's interest rate decision. But for a technical analysis, I think we should look at the pound. So yesterday's employment data supported the British pound. Why? It came in better than expected, so implying a tight labor market, which provided support. Yet today's GDP rate was slightly disappointing. However, we're not seeing a slowdown in the pound. So this may not be the pound strength. This may not be a form of pound strength, but rather dollar weakness. So support and resistance. So the next target we can note. Let's just find R3 before we place in our text boxes, clearly indicating where our support and resistance levels are. This is too far. There's too big of a difference between R2 and R3 for it to be placed there. So we're going further back. Once again, slightly too narrow. Prior to a big move downwards, yet we need to see it's about 76 pips. As I've said, I'd rather have the bodies rather than the wicks. And then 6. So 1 point it would be at 1.2878. So let's just place them in. So S1 at 1.2615. S2 at 1.2535. and S3 at 1.2465. So this would be our S3. R1 would be at 1.2675. And with R2 being placed at 1.2770. And then lastly, we would place R3 at 1.2878. And this will be my R3. So just to recap, bullish outlook for the pair, despite the GDP rates coming in lower than anticipated for the British economy. We're seeing that the overall weakness of the greenback has allowed other currency pairs to capitalize on that weakness, which may be represented by the pound in this pair, hence moving higher. Support a resistance to support, now moving towards R1. So for a bullish outlook to continue, breaking above R1, next target being R2. Whereas for a bearish outlook, breaking below S1 and moving towards S2. Yet our RSI indicator is above the figure of 50 and near 70, implying a strong bullish market sentiment. So that's it for today. Thank you, and until next time.
Hello, welcome to another of one of our helpful videos. Today, we'll be taking a look at what a call option is. Also known as a high option, a call option is a financial contract between two parties to which the buyer is given the right but not the obligation to purchase a financial instrument or stock from a call option seller at a set price on or before a specific date. The instrument is called the underlying asset. When the price of the underlying asset increases, you will see a profit. The cost of buying the call option is called the premium. The premium acts like your insurance against the large loss. This is because the sum you pay for the option is the maximum amount you can stand to lose on that option. The last day the option contract is valid is called the expiration date or time to maturity. It is the date by which you'll need to exercise your right to buy the asset. If you don't, the option loses its value and you essentially forfeit the premium you paid. The set price is also called the strike price. It's the fee the seller agrees to sell the asset for on or before the expiration date of the contract. So, why does someone typically buy call options? Well, call options are usually purchased to make a profit on stock. They're also considered low risk because the most that you can lose is the premium you paid. But as always, be cautious when trading and understand all the risks that come with it. Thank you for watching.
Let us begin. So yeah, welcome to another webinar series brought to you by IronFX. So today we'll be going through the Fibonacci series, 3 out of 4 on expansions. So I got to read the disclaimer first, so do bear with me. So the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So this material is just the personal opinion of the author, which is myself, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained. Redistribution of the material is strictly prohibited. Hey, hi there, Andrew Robinson. Okay, I was just about to start the webinar on Fibonacci series, part 3 of 4 on expansions. Okay, just a very, very quick introduction to myself. My name is Chen Yongjing and I'm actually from Everest Fortune Group. So we are actually the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a very, very special collaboration with IronFX where we are bringing you guys the good stuff. Okay, before we begin, so I'll just show you guys. So if you want to find out more of these free webinars like this in the future, you can go under ironfx.com, under IronFX School, under webinars. So you can click on it, and then I'll send the link to the chat also. So that's where you can sign up for future webinars like this. Okay, where's it? Webinars. Okay, where's that link? Okay, I think I have an ad blocker in place. Okay, it's right here. At the bottom. Okay, I just saw it disappeared again. All right, here. Okay, so yeah, right there, Fibonacci series, 3 out of 4 expansions. Next, we actually have Jindal and Sarah, which is tomorrow. Okay, there's also the IronFX YouTube channel. You can actually watch replays on the past live that we have actually went through. So I'll send the link to the YouTube channel. You guys can check it out there. And last but not least, if you want to contact me outside of this webinar, you can actually contact me through this link right here. I just send the link to the chat already. It's a Linktree link about myself. Is basically a portfolio of myself, LinkedIn profile, and everything else about me. So feel free to check it out. Follow me there if you're interested. Ask me any questions that you want outside of this webinar. All right, let us begin. Okay, so a few topics to cover today. Few agendas, a recap on Fibonacci retracement essentials, ideal market structure, significant swings, and following the market trend. We also have the different Fib retracement levels and what are Fibonacci expansions, which is the main highlights of this webinar, and going through confluence levels. So let us begin. So Fibonacci retracement checklist, just a very, very quick look at this. The market structure, is it clear or not? Look for big zigzags. So actually you notice that the market is moving very, very closely along the Fibonacci trend line. So you can actually see this nice little blue line right there going through the charts. Let me clear this out. So it's actually a very, very clear structure, very, very clear downtrend, bearish market. So identify the recent trend, prices going up or down. In this scenario, it's going down. So you connect the two extreme points, drawing from the top of the swing high, which is the starting point, to the bottom of the swing low. So this is how you draw a Fibonacci retracement. Okay, looking at this, insignificant swings. Recap. You are not going to care about all these tiny, tiny movements on the chart. Take a look. So look at this GIF, is actually drawing out all the insignificant swings or using the orange highlighter. It's too insignificant, so you cannot just draw randomly, you know, from this tiny little swing up to this high right there. It's not significant enough. You need to be drawing from this significant swing low right there to this highest point somewhere there. So you draw the Fibonacci, it should look something like this. That is a proper significant swing. So if you want, I can actually show an example on the chart. Maybe there's an example. Okay, insignificant swing showed you already. This is too insignificant. All these kind of swings right here, too insignificant to even draw out. Okay, let me see. So this is actually a very, very nice significant swing move right there. Can see? From a swing high, drawing towards a swing low. So it's actually a significant move up with obvious, clear market movements. Okay, let me check the previous slide first. Did I miss out anything? Okay. Next, drawing a significant swing. So here's another example of significant swings. So I've actually drawn out the peaks and troughs to point out exactly how clear it should be. So this could be a significant, where is it? Significant swing point. Swing points towards the downside. So you should only be focusing on this. This is just minor swings, which is insignificant. Focus on this that I've circled out, drawing the Fibonacci from the top to the bottom. So it's a very, very clear-cut swing right there. Okay, next, let me move on. So next, following the market structure. So the Fibonacci retracement, here's an example of how to not draw a Fib retracement trend line. Your Fibonacci trend line must follow price structure clearly. Hello there, Olivia Ponche. What time frame do you use? Well, time frame doesn't matter. Even on 1 minute, you have to find something that is significant. It even works on the 1 hour time frame, 4 hour time frame, 15 minutes time frame. So I'll show you. Since you're asking that, I'll show you an example. Okay. Let's move on to the live chart first. So let's start from the daily. The daily chart. So if you want to draw a Fibonacci trend line from the daily chart, you should be drawing from this significant swing high right there to the next significant swing low right there. So in order to use the Fibonacci trend line, the tool is right here on the left side of trading view. You should be going right here. Trend line 1, 2, 3, you expand it out. It should be called the Fib retracement tool. So you draw it from the top of the swing high, draw it to the bottom. You notice that it's very, very nice. There's a very, very significant swing. So clearly, price is currently trying to reach towards the 50% Fibonacci retracement line. So it's right here at the 50%. We can possibly see, so for example, right here, euro dollar to likely head towards the 1.09440 level, which is also the Fibonacci 50% retracement. Okay, let's move on down towards the daily, towards the 4 hour chart to draw another one. So let's move down to the 4 hours. So we are looking at a significant swings. So this could be a very, very significant swing. So a swing right here towards a significant swing towards the downside. So you can actually draw a Fibonacci line from the bottom towards the top. You actually notice that price actually retraced back down towards the 61.8% before it continued pushing bullish. So another point you can draw out is, since that point swung up, this was a significant swing, and then this was a significant swing high. Same thing, you draw a Fibonacci line from the bottom to the top. It's following very, very closely, very, very nice. And then it swung down. Where did it retrace towards? That's the question. It retraced towards the 61.8% Fibonacci line before pushing higher. All right. So let me find a clear-cut one. So there isn't anything clear at the moment that we can actually draw out. Okay, let's move down. Okay, before I move on, this could also be another significant swing. Look at this very, very obvious swing towards the downside. You can start to draw a Fibonacci line. Drawing from the top to the bottom, and you notice that price also retraced back up towards the 61.8% Fibonacci line before rejecting back down. So that's a very, very nice way to draw your Fib levels. So next, let me show one last example before we move on towards the 1 hour chart. It's actually the same on all time frames. So this is a significant high, significant low, can draw price actually retrace all the way up towards the 61.8% before rejecting towards the downside. So time frame doesn't matter as long as you know how to draw your chart properly. Everything works well. Hey, hi there, Xion on Yen Ni. Hi there. Let's move on towards the 1 hour chart. Okay. So by the way, those who have just joined, I've actually turned on the chat already. So you can ask me any questions there within the chat. You can talk to me there. Ask me any questions while moving on. If you do not understand, feel free to ask any questions. Do not feel that you are slowing down the entire webinar. If you do not understand, that's what we are here to. We are here to learn. So looking at this 1 hour chart, this could be a significant swing high. This was a swing high. It went all the way back down. A significant swing low. It retraced back towards the 61.8% Fibonacci line. So it went down, tapped, and rejected towards the downside. Okay, next. This was also a very, very obvious. You only would be drawing Fibonacci line at the very obvious points. Significant swings. So you draw a Fibonacci line from the top towards the bottom. Price actually retraced from the bottom towards the 61.8% Fibonacci line before, it kind of short sellers try to take over, but the buyers took hold. So likely we can see euro dollar continue moving to the upside. Okay, so just move on 30 minutes. I'll just continue making it faster and faster. So this is actually quite a significant swing also. Significant swing, it actually swung up, hit back down, and retraced back up. So you can draw a Fibonacci line from the bottom towards the top. It likely retraced towards the 23.6% Fibonacci line. You can see right there. Very, very clear cut. Price very, very nicely moving. Hit back down, retrace, and shot right up. Hey, hi there, Rajesh Rama. And hi there, Tivin Campbell. Okay, Juha, you actually want to see Brent's oil retracements. Well, let's go towards that. So if you are watching on your computer, feel free to open TradingView. Let's practice this together. Hopefully we can improve our trading together. Okay, let me turn on crude oil. All right, crude oil, Brent crude oil. Okay, looking at this, okay, maybe I should move towards the 1 hour chart. It's a very, very obvious significant swing high right there that we are looking at before price swung all the way down. So we can actually draw a Fibonacci line from the top to the bottom, and you notice that price likely just tapped very, very nicely within the 50% Fibonacci line before it rejected towards the downside. So these very, very clear cuts, very, very obvious, and it's extremely clean. You notice it's very, very close to with the Fibonacci trend line, bearish trend line. So next, another one I would like to show you. Looking at this specific scenario, very, very obvious swing, very, very obvious swing low. You can draw a Fibonacci line from the top to the bottom. Price actually retraced back up to the 78.6% Fibonacci line So it's quite a high retracement price, followed very, very nicely before it retraces back up and short towards the downside. Okay, let's move on back to the chart, to the PowerPoint presentation. Okay, so let's go through this one more time. Fibonacci lines, retracement lines should not cut through two large areas of the market structure. So in this specific scenario, this actually cut through the trend line. It's not valid anymore. It's not clear. It should be following the market structure very, very cleanly. So when you're drawing a trend line, you should follow the price of movement and not deviate too much. Any questions so far? Feel free to let me know in the chat. Okay, let's move on. Okay, as I mentioned just now, through that practice that we had, price is following very, very nicely with the market structure. So you saw it's following very, very nicely. That's how you should be drawing a Fibonacci retracement trend line. So it works well when it follows price movements, and Fibonacci lines actually work better on higher time frame. Why? It's because it's due to less noise. Less noise as in less deviation away. So price does not move away too much from the Fibonacci trend line. Okay, next, let's move on. Okay, clear market structure. This is actually very, very clear cut. This is a very, very nice very nice market structure. So although a fib retracement can also be used in both choppy and trending markets, so it's important to look for clear market structure. So in this case right here, clear swing high, swing low, clear swing high, and a clear swing low. Then clear swing high again, clear swing low, and another clear swing high. So if you want to screenshot this, please screenshot this now before we continue. You can whip out your phone, take photo before we continue. Okay, next. This is a very, very unclear market structure that we do not like at all. Okay, so you see, price does not, where is it? Price, there's no significant swings at all. Price is very, very choppy and it suddenly moves up. Even the downward, it deviates. Let me clear everything. Even if you try to draw a Fibonacci line from the top of this swing high towards this swing low, is totally wrong. It's because price, this area deviates quite far away from the trend line. Same thing if you draw from the bottom to the top, the bottom right here to the top, if you actually draw a line across, it's not that clear because price went up and it's this area, it actually retraced too much. So it deviates quite far away. What you want is for the trend line and price to be relatively close with it. Okay, let us move on. So there are actually fib numbers that we typically use in trading. You can actually take a screenshot now if you want. Please screenshot this down. It's very, very important. Screenshot this down and please apply it. Please try to apply Fibonacci trend lines when you are trading. So now that we know how to draw the fib retracement trend line, let's look at the different types of levels ranging from negative to above 100%. So although the tool used is Fibonacci retracement, it can lead to 3 types of Fibonacci expansions. Those below 0%, which is the Fibonacci expansions right here, negative 61.8% and negative 27.2%. You will only be using these two. So retracements, those from 0 to 100%, which is the regular ones. Right here, regular ones, 0 to 100%, and extensions, Fibonacci extensions for those above 100%, which is the 127.2% and the 161.8% Fibonacci extension. So we will go through expansion and extensions more in depth in the coming webinars. So in this webinar, we will just briefly introduce the levels. So I'll give you guys one last chance to actually screenshot this down, take a photo before we continue. All right. Okay, let us move on. Okay, here you can see all the different Fib numbers that we mentioned in the previous slide and how it looks drawn out. So take a note of the starting and ending points. So we started drawing from here and ended drawing here. So take note of the starting and ending points of our Fibonacci trend line, the mid-range retracements, negative expansions. So the negative Fibonacci expansions are right here. And the above 100, the positive Fibonacci retracements. So in all of these three Fibonacci scenarios, we are only using one tool at the end of the day, which is the Fibonacci retracement. All right, let's move on. Okay, today we'll just be focusing on the negative Fibonacci expansion. So using the Fibonacci retracement tool, we make use of the negative levels, namely the negative 61.8% and negative 27.2% Fibonacci levels. So when using the tool, look out for flash, zigzag, or lightning symbol. So ideally, price should retrace at least 50% in 0.3 as shown in the video right here before reversing off. So take a look, draw from starting to ending, retrace at least 50%. Before you notice, price actually rejected off the negative 27.2% Fibonacci line. Okay, take a look. It looks like a zigzag, like a Harry Potter zigzag line. So the explanation, the clearer the movement of the flash zigzag, the better. We ideally need to wait for prices to retrace at least 50% in 0.3 before taking off in the other direction. Okay, so maybe I'll just watch through it one more time. It actually rejected right here, rejected back down towards the downside. Okay, next, Fibonacci expansion. Okay, let me see. So here is an example of expansion and how it plays out. So starting and ending points, take note of it. Starting right here, ending point right there. Price actually retraced back up to the 61.8% level. So we show how to make use of the support in the negatives. So potentially we want to look out for flash zigzag, potentially look for price to retrace back up before heading downwards towards the negative 27.2% Fibonacci retracement line. We take a look, price actually retraced back down towards the negative 27.2%. Okay. Okay. Bounce back up. So take a look, price when it touches very, very nicely within the negative 27.2%, price usually comes back to the ending point. So yeah, please screenshot this down before we continue. Please screenshot this down, just showing examples of how it works. Okay. Next, let us move on. Take a look. Even at the negative 61.8%, price actually tapping ultimately into that. You are drawing from the starting point to the end point, price went up, retraced back down, and went back up towards the negative 61.8% retracements before heading back down towards the end points, which is right here. So yeah, you can actually use the negative expansions, negative 61.8% and negative 27.2% as a potential take profit target. So once price steps into that level, you can look to actually close out your trade already. Just in case price reverses back down like in this scenario. So let us continue. Okay, so take note of the shape of the flash. Make sure price reverses to at least 50% before breaking the starting point. So we draw it from the starting point towards the end points right there. So price retraces back at least 50%. So from bottom to the top, at least 50%. And then it hits down towards the negative 27.2% Fibonacci expansion level. So notice price steps into that and immediately bounces right back up. So please screenshot this down also before we continue. This is the example number 3. Right, give it a moment. Okay, let us continue. Okay, so next, looking at, in this GIF right here. So take note of the shape outlined by the orange arrow. So price retraces more than 50% of the Fibonacci trend line. So in this case, more than 100% and reverses nicely off the 27.2% Fibonacci expansion. So take a look, price retraces back down. So maybe we can start doing some, some kind of practice session, intense practice session. So let's find an example. Okay, if you notice right here, I'll be drawing a Fibonacci line from this significance swing high towards the significance swing low. Hey, hi there, Samuel Julian. Nice to see you. So we'll be drawing the Fib from the top towards the bottom. So just now, as I mentioned, price retraced back up towards the 78, at least 50%, 78.6. So we can actually start to see price possibly heading towards the expansion level, negative 27.2%. So notice price actually tapped very, very closely, went down, tapped pretty closely towards the negative 27.2% before it retraces back up. So yeah, this is one example on the live charts. So maybe we can start to look for more. Okay, let me find another one. Maybe likely, possibly looking at the euro dollar. This is a currency pair that I like to look at a lot. Okay. Let me find it on the 1 hour. Okay, let me find a clear one instead. Okay, maybe let's take a look at this. I'll test it out. Okay, didn't bounce, didn't retrace, not good enough. Let me find this. Okay, this is a pretty nice one. If you take a look, instead of 78.6, let me find 50%. So notice, I will be drawing a Fibonacci line from the bottom of the swing low towards the swing high, and then price went up, retrace back down towards the 50% Fibonacci line before pushing up relatively close towards the negative 27.2% level before it actually retraced back down. So just take note, that's how you actually use the Fibonacci expansion levels. So let us find another example, another nice example. Okay, let me find it. Okay, trying to find a clean one, at least 50%. All right, so likely this scenario, so let me test it out. It wasn't close. This is not the greatest example because I'll be drawing from the swing high towards the swing low. Price actually retraced back up towards the 50% Fibonacci line before heading relatively close, not close enough, towards the negative 27.2% before it just shot right up. So let me find another example. We'll be just doing practice sessions like this. Okay. Okay, this is quite nice. Okay, let me draw. Is it good enough? Okay, it's actually not good enough. Why is this not valid? This is not a nice Fibonacci line because price actually deviated quite far away from this trend line right there. So this is not a good example. So let us move on. Let me find another one which is nice. All right. Clean one, trying to find a clean one. Likely this could be possible. Okay, this is actually quite nice. So you notice that price swung from this swing high towards this low, and it retraced back up towards the 50% Fibonacci line right there before it shot down towards the, I think it did hit the negative 27, negative 61.8%. So it actually didn't, it went towards the negative 27.2% Fibonacci expansion line before it kind of consolidated before shooting back up. So yeah, always just try to look at the negative 27.2% as a potential take profit target. Okay, let's find another one. Find another significant swing. So yeah, this is actually quite a nice one. So you notice that we have a pretty much a significant swing right there. So I'll be drawing a Fibonacci line from the bottom to the top. You notice that price actually retraced down to at least the, let me draw it out, at least the 50% Fibonacci line. Price went up, relatively nice, went back down, retested, went back up, relatively close towards the negative 27.2% Fibonacci line before it rejected back down. So relatively close, pretty close, you can start to close out your trade already. So if you're actually aiming for exactly negative 27.2%, you might actually miss your close and not hit take profit. Okay, next. Let's find another example right there. 50%, there isn't anything nice. So maybe I'll move on towards the H4 chart so I can view things clearly. All right. Okay, maybe this right here. It is not clean enough. If I actually draw a trend line, I was looking at this area, wanted to draw a trend line right there. But what happened? It wasn't clear cut enough. It's pretty clear. All of a sudden, it deviates quite far away and it shot right back up. So this area actually caused me to not want to view this Fibonacci trend line as a valid one. Okay, let's find another one to practice. Okay. Okay, this is pretty nice. This is quite nice, drawing from this significant swing high right there. Okay, this is not significant enough. Let me find another one. This clear cut enough. I think I might be looking at one. So this is quite a nice swing high. Okay, but it did not retrace to 50%. Okay, maybe it did. Okay, here is quite nice. So take a look at the H4 chart. So from this significant swing high towards this significant swing low, price is moving very, very closely along the trend line, tap right into it, shot right back up, retrace towards the 50% Fibonacci line before heading down towards the negative 27.2% Fibonacci expansion line. So what happens after price steps into that? As we have done many back tests, price actually consolidated a bit before rejecting back up towards the starting points of this trend line, of the end points. So if you actually draw a box over, this is where you draw the fib. All right, any questions so far? Do let me know in the chat, since we are here to learn. Anything you guys do not understand, just ask me. I'll try my best to answer you. Okay, let me check if this is significant enough. Okay, this is actually not bad. So drawing from a significant swing high towards the significant swing low, price is very, very nicely along this trend line, went back up, retested the 50% Fibonacci line before it shot right down towards the negative 27.2 Fibonacci retracement line. So just now, as I mentioned, price usually hits back up to retest the endpoint, the previous swing low. So I'll just draw a box out, an extended box, maybe an extended box red. You notice that price actually more or less hits back up towards that area. So it taps into also the negative 61.8% before it rejected, and relatively near towards the starting point, the end points of the Fibonacci line, and then just continued heading back. So what do we call an area like this? We can call it an overlap resistance. So I'll just type it out in case you don't know how to spell it or don't know what I'm talking about. It's the overlap resistance. So inside center break. All right. So yeah, if you want, please screenshot this down before we continue. Okay, I'll just screenshot this down and send it to the chat. Copy link to chart image, send it. All right, I've just sent the link to the chat. You guys can actually check it out right there. So it's actually quite clear cut on that. We can actually move on. Okay, next. Let me move back towards the slide that we are going through. Okay, this not okay. Invalid Fibonacci. When does a fib retracement becomes invalid? So one of the most common scenarios is when price makes a lower low. Assuming you are drawing a Fibonacci retracement from the top to the bottom, like in the picture. Okay, never mind, like in the picture. So if there are bars on the right that breaks your ending point, it becomes invalid. Just like I mentioned, it deviates quite far away, invalid. There are Fibonacci retracements. They are negative 27.2%, negative 61.8%. And we will touch on them as they basically go through your endpoint, yet they are still valid. So take a look. Price breaks the points. We want to draw from the top towards the bottom, but price didn't retrace back up to 50% level, at least 50%, and it continues going down. So this kind of no longer valid already. Always look for at least 50% retracement. Okay, next we are going through combining Fibonacci levels. So it's for confluence to our trade. Okay, give me a moment. Okay, the trick is to find multiple Fibonacci retracement levels lining up together so that you can increase the probability of a bunch of Fibonacci retracement levels working versus a single Fibonacci retracement level working. So this is the definition of a Fibonacci confluence. So I'm just showing a very, very quick example. The negative 27.2% Fibonacci expansion is in line with the 161.8% Fibonacci extension, in line with the 78.6% Fibonacci projection. So many confluence of these levels, and then price just bounce right back up. So maybe I can show an example on the live chart. So let's take a look. I'll try to find one which is nice. So maybe why price bounce right off that area. Likely we can try to see something. Okay, there, negative 61.8. and an expansion. Okay, there isn't a level right there. So I'm trying to find a nice level, a projection level. Okay, we don't have it right there. Don't have it. Not clear cut enough. Expansion drawing up. Okay, maybe we might have something right here. Okay, there's nothing right here. No confluence levels yet. Showing a fib. No confluence yet. Okay, let me find one. I've got to find an example for you guys so you guys can understand. Wait. Maybe this level. Okay, maybe this nice level right here. So can draw a Fibonacci line. This is quite a nice tick. Okay. So we actually have a nice Fibonacci. We can draw a projection from the top to the bottom and then towards the top again. Likely we might be able to find some kind of confluence right there. Okay, this is very, very weird. Let me move on towards the 1 hour. Try to find one that is significant enough for that bounce. Projection levels. Okay, this could be it. Try from the bottom, top, up. So with the 100%, I'm actually looking at this area right here, checking whether there was any Fibonacci confluence that caused price to retrace back down. Drawing a fib towards the bottom. Okay, there isn't any. Okay, that's weird. Let me just give me a moment. I'm still finding. Okay, this is not the one. Projection, top, bottom, and back up. 78.6%. Draw a fib. Okay, this is actually quite nice. Quite a nice retracement area. I'll draw the 138. So you actually notice that price actually. Wait, give me a moment. Let me clear this out. Trying to stick everything clearly in place. Just to show you guys how it works. So Fibonacci line, then we also have another line or fibs. Okay, this is not the confluence. If you actually draw, notice that price actually tapped very, very nicely in the 127.2% Fibonacci extension level. So I'll just extended box green. So with that two confluence in place, 127.2% Fibonacci extension. Extension is the positive side. Expansion is the negative side. So we also have the 78.6% Fibonacci projection. So that's how we use it. You can possibly look for a buy entry right there for price to tap and rebound towards the upside. All right. Let us take a look next. Let's find another confluence. Okay. Okay, let me find. Okay. Potentially this might be it. Let me find. All fibs. Okay, negative 61.8%. Showing a Fibonacci expansion, top to bottom. Okay, this is actually quite nice. If you actually take a look, the negative the 78.6% projection and the 161.8% Fibonacci projection. Take a look. So I draw a projection from here. Bam, bam, bam. That's how I draw a projection. Getting the 78.6% Fibonacci projection. We also draw a Fibonacci line from the top to the bottom. We have the, so over here is the 78.6% Fibonacci projection. We also have the 161.8% Fibonacci extension. So these two right there actually added confluence to why price actually rejected back down. So price tapped into that level and rejected strongly towards the downside. So just draw that level out. It's quite clear cut right there. Went up, tap, rejected back down. Where does it reverse towards? It actually reverses towards the more or less the starting points of this Fibonacci high, the previous high right there. So you can call it a support, an overlap support if you want, extended box green. So this could be a nice sell entry that you could have caught right there. So I'll just copy link to the chart image. I'll just screenshot and just send it to you guys. I'll just send the link to the chat already. So any more questions, let me know. Any more questions that you do not understand on Fibonacci confluence, let me know. So let us continue and end this slide. So this another example, negative 27.2% expansion. Just showing examples. I don't expect you guys to, at the end of this session to be able to immediately implement it. You might want to go through some practice drawing on your trading view chart before you start to look for potential buy entries, reversal entries. Okay, let me find what else is needed. All right, for this example, price broke through the negative 127.2% and the negative 27.2%. And then price went towards the negative 61.8% Fibonacci expansion and towards the 161.8% Fibonacci extension. Price then tapped and reversed back down. So that area actually gives us a pretty strong confluence area that price can possibly reverse. Okay, same thing. Drawing down negative 27.2%, 127.2%, and even a 100% Fibonacci projection. So this entire area right here actually added confluence that price could potentially reverse and point back up. So price then proceeded to bounce off this very, very strong level. There's many confluence. Here, hi there, Steffi, tap in. Okay, let me go through this. So stop loss beyond, what does it mean? It means that you should always put your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence, and if your stop loss is right before instead of beyond the area, Fibonacci confluence area, you can potentially hit your stop loss, get stopped right up when the market starts to reverse. And then traders start to complain about getting stop hunted, saying the brokers manipulated the market. It's actually not. It's actually there was confluence. There was a confluence, caused price to tap in before reversing back up. So take profit before. What does it mean? It means that you should always put your take profit target before a key Fibonacci confluence area. The reason for this is because when price reaches the Fibonacci confluence area, the reason for this is because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it, and instead of reaching your profit target, it reverses back to your entry. So always put your take profit target just before the Fibonacci confluence area. Just slightly before, 1 or 2 pips before would be nice. So this is one of the reasons why people complain that the market is manipulated, because they miss their take profit target by 1 pip. So yeah, you can actually screenshot this down before we continue. All right. So once you guys have screenshotted it down, take photo down, let's move on. So we have come to the end of this webinar. So yeah, really thank you guys for joining. If you guys have any more questions, let me know. I'll give you guys 1 more minute. 1 more minute to ask me any more questions before I end this webinar. So until my time, 6:53, I'll be waiting for your questions. So meanwhile, while waiting for your questions, I would like to say that tonight Okay, for my time, it's tonight. It will be when I'm sleeping. It will be 2 a.m. for me when the FOMC news actually happens. So yeah, just take care trading. Please try not to enter any scalps just before the FOMC news. You can potentially get stopped out. And also Friday, we have the NFP. The entire week is really, really, very volatile. Hey, no problem, Juha. Hey, see you next time. See you next time. See you guys next time. Appreciate you guys for joining. All right. So let me just send that link one last time. Link 3. That's the link you guys can actually find me, can actually contact me there if you want after the webinar. So yeah, thank you, Juha. Thank you, Peter, Benny Brook. Thank you, Samuel, Julian, for joining. Hope to see you guys next time and really take care. Stay safe trading. Hey, goodbye, guys. I'll be ending the stream now.